Okay, you guys, we're now going to take a look at a couple exercises dealing with notes receivable. The first one, exercise 714, similar to one you've seen before back in financial accounting. It's an interest-bearing note with an adjusting entry, and then we're going to take a look at exercise 715. They call it a non-interest-bearing note, but you've heard the old saying, there's no such thing as a free lunch. Well, there's no such thing as an interest-free loan either. We're going to have to impute interest there. So we'll take a look at both of those, and then we're probably going to pick up a petty cash problem in this chapter as well. But let's start with exercise 714 on page 407. They say on June 30th, 2016, the Esquire Company sold some merchandise to a customer for $30,000. In payment, Esquire agreed to accept a 6% note requiring payment of interest and principal on March 31st, 2017, which looks like 9 months later, right? You had 6 months remaining in 2016, 3 months in 2017, so a 9-month note. The 6% rate is appropriate in this situation. Okay, prepare the journal entries to record the sale of merchandise. They say omit the cost of goods sold entry, the December 31st, 2016 interest accrual, that's our adjusting entry at the end of the year, and then the March 31, 2017 collection. Okay, first let's record the sale itself. Okay, and that took place on June 30th. Alright, so what did we receive? Well, we did not receive cash, and we didn't make, so we wouldn't debit cash. We did not make the sale on account, so we wouldn't debit accounts receivable. Instead, we took a note for the sale, so we're going to debit note receivable or notes receivable for the actual amount of the sale itself, $30,000, and then we're going to credit sales. Okay, there's our June 30th entry. Then on December 31st, we have to record interest through the first 9 months. Excuse me, I said through the first 9 months. Actually, from June 30th to December 31st would only be 6 months. Now, this would be an adjusting journal entry that we'd make for interest earned during those 6 months. At the end of the year, this business is using the calendar year as their fiscal year, so we'll debit interest receivable for interest earned so far. Well, that's going to be equal to $30,000 times the rate was 6%. That's how much it would be for a year, times 6 months, 6 over 12, same as 0.5, right? 6/12 would be the same as 0.5. That one's $900. That's how much interest was earned from June 30th to December 31st. We don't debit cash because we haven't been paid yet. We'll increase the balance of the asset account interest receivable. We've earned it this year in 2016, so we'll credit it to interest revenue. Like I said, this is kind of a review for you if you had me in financial accounting, but I wanted to show it to you first before we look at the non-interest bearing note, which is quite a bit different. Alright, and then the March 31st, 2017 collection. Well, we're going to debit cash because on March 31st the customer is going to pay us. Well, let's see if I can get this formula in here correctly. What are they going to pay us? Well, they're going to start with the principal amount, $30,000. plus interest, which would be calculated as 30,000 times 6% times 9 months over 12, which is the same as 0.75. See if that works. No, it doesn't. Let's see. I just got my formula in wrong somehow. Maybe I need brackets here. So here's the principal amount plus interest over here. Put brackets around everything. Okay. Maybe I don't need that. If this doesn't work, we'll calculate it on another page. There we go. Now let's look at it again. What did I do here? 30,000 principal plus interest, which is 30,000 at 6% for 3/4 of a year, 9 over 12. So interest in total would be $1,350 because the note was for 30,000. That's how much cash we'd receive. The asset we're giving up is the note receivable. It's an asset that decreased for the face amount, 30,000. Another asset we'd be giving up would be interest receivable. So the amount placed in interest receivable last year for this note, $900. And then we'll credit interest revenue for interest earned in year 2. Well, you could say the 31,350 minus these two, or you could say 30,000 times 0.06 times 3 months out of the let's see, it's the 3 months in the new year. So 3 months divided by 12, that's what, 25% of the year? 450, and that should balance. 900 plus 450s, 1,350, plus 30,000s, 31,350. Okay, that takes care of our entries there. And that's all of instruction 1. Now instruction 2 wants to know if the December 31st adjusting entry for the interest accrual is not prepared, by how much will income before income taxes be over or understated in 2016 and 2017? What they're saying is, if we didn't make this entry, how much would income be over or understated in this year, 2016, and in this year, 2017? Well, if we didn't make this entry, then we would be lacking revenues in 2016. So I'm going to come over here. Okay, so if we didn't make this adjusting entry, then we would have been leaving off interest revenue of $900 in 2016. So in 2016, income would be understated by $900. That means all of that revenue would have gotten recorded in 2016. 2017, instead of just the $450 in 2017, an extra $900 in interest revenue would have been recorded in 2017. So in 2017, income would have been overstated by $900 again in 2017. Alright, I don't think after working that one with me, you shouldn't have any trouble with exercise 714 on the Connect Plus site. Thanks.